Today I'm going to discuss with cost volume profit analysis, which is also called CVP analysis, right? So this is cost volume analysis in managerial accounting. So some of the terms that I'm just going to explain first. The first is the operating income. Like this is a kind of like income from all the operations. So which is denoted with the OI, and Q is here quantity, and SP is the selling price. And here that 10, for example, 10 per unit is the selling price here that we have taken just for example. Variable cost, which is denoted with the VC, is a 6 unit, right? This is the variable cost. As the sale increase, variable cost increase. As the sale decrease, variable cost will decrease. It is not like the fixed cost that will remain the fixed irrespective of the sale increase or decrease. CM is the contribution margin, which we know that SP minus VC means selling price minus variable cost, right? So that will be the contribution margin. So contribution margin is how much contributing that you to increase the sale. More and more contribution, maybe marketing, selling, and some strategies that you are implementing in the selling and promotions, or maybe for the selling of the goods and services. So that will be the contribution that you are making. More and more contribution, more profit that you will get. So that's why it's known as like contribution margin. But if there is uh, more sale, more expenses, mean more variable cost, whether it's a more sale or like more variable cost, but the fixed cost that will remain same, so that we are not considering here. So the contribution margin that will be SP minus VC. So fixed cost is 3000 here, and operating income is equal to, we know that, revenue, which is also known as sale, minus expenses. If we talk about the expenses, expenses are variable cost plus fixed cost. So these are the two kind of expenses that we see in the manufacturing organization, in the manufacturing units. So what we can do, so here SP selling price, and the quantity that we have, variable cost, the quantity that we have, minus fixed cost. And here the Q that I have taken as separate here, the common, SP minus VC minus FC. And after then the Q, SP minus VC, that we know that SP minus VC here is CM. So Q CM minus FC. So in this way, we will be able to calculate the Q. So we can find Q. So Q is equal to here. We can say the Q will remain here. FC is a minus, that will go here and will become a plus. So OI plus FC is equal to QCM, means contribution margin. So Q will remain here, which is multiply here, will be divisible other side of the is equal to sign. So the formula is here, in case that we want to know the quantity, right? We want to know the quantity sold, then we will be able to know this with the OI plus FC divided by contribution margin. So this is the formula that we have prepared here today. Okay, so now we want to know something. For example, target profit analysis. This is the one that we want to know. We want to know that if we want to earn $5,000 profit, maybe in a month or in a quarter, how we will be able to know that how many units are required to be sold. So this is the formula in front of us. This much of quantity is required so that we can earn profit. So we want to know the quantity. So how to do this one? Some of the figures are available with us. Let's see what are those figures. The first is the profit. So profit means OI, operating income, plus a fixed cost that we have already mentioned here. The fixed cost here is the 3000, means the 5000 plus 3000, which is written here, and contribution margin, we know that as selling price minus variable cost, means 4. So 5 plus 3 divided by 4 is a 2000 unit. It means if we want to earn $5,000 profit, we need to sell 2000 units in our company. So this is the target profit analysis we have completed. Now the second thing is, if we want to know the break even. So break-even point. So break-even point means no profit, no loss. How much quantity that we will sell if we find no profit, no loss in the company. So that is known as break-even point units. So how to calculate? It's very, very easy. Exactly the same formula that we have here, that we are going to implement exactly same formula here. In this case, we know that we want to earn $5,000 as the profit, but now we want to earn a $0 as the profit. So no profit, no loss. 0 plus 3,000 is the fixed expenses, right? Divide by 4, right? So divide by 4 contribution margin. So now in this case, so what I'm going to do, 3,000 divided by 4 is equal to 750 units. That is the break-even point. So the answer is 750. So once, if we sell 750 units, then there will be no profit, no loss, right? So which is depicted here is a 750. This is the 750 units that if we sold it, no profit, no loss. So now if we want to know about the break-even sales in dollar, so how we can calculate? So this is also one of the formula. So this says that's fixed cost divided by CM ratio. So what is the CM ratio? So CM ratio is already that we know this is 10 minus 6 is equal to 4 divided by 100. So that will be 0.04. Okay, so now our CM ratio is the sale minus variable cost divided by sale. So what is the selling price here? So selling price here is 10 minus 10 minus 6 divide by 10. Now it means 4 divided by 10. So it means 0.40. So 0.40. So this is what this is CM ratio that we have calculated here. So with the help of this formula. Right. So in this case, if we want to know what is the contribution like a break-even point, contribution margin that we have, contribution margin ratio we have. So the contribution margin ratio that we will use here to know the break-even sales in dollars. Let's say, what is the fixed cost? First of all, the fixed cost we have a $3,000. So $3,000 is the fixed cost divided by contribution margin ratio that we have already calculated. So that is 0.40. So if we calculate this one, then what will be the answer? What will the break even sales in dollars? So that will be $3,000 divided by 0.040. So in this case, we will find that if we sell, if the sale is a $7,500. So this is the sale. 7,500 is the required sale volume if you talk about, right? This much of sale is required, right? So if we want to verify this, how we can verify? So look at this. We can verify that we know what is the break-even point. We know this is the break-even point 750. So we can do that like 750 units is the break-even points units multiplied by we know the selling price. The selling price is the $10 per unit. So here $10, this is $10, right? So per unit. Exactly the same answer we will get it here. So hence we proved that so the break-even sales in dollar that will be 7,500. So this is that we have learned something, then some overview of a cost volume profit analysis, right? And after then, I'm just going to explain you about the absorption cost. So what is absorption cost? Look at this. The absorption cost is an accounting method that can provide invariable insight into the full cost of production and individual product. It is required and a requirement of the gap is generally accepted accounting principle for external reporting, right? So it means that this method, uh, absorption costing, is used in the financial accounting to show to the outside world, not to the internals. Okay, so now the next point is we have here, let's say the ABC company. We have ABC company here. We know the production, sales, remains, and everything we have given here. Let's say the production is 10,000 unit in a month, right? So we have 10,000 units in a month sold. This is the production, and how many units have been sold is 8,000 units, and the remaining means closing stock that we have 2,000 units. And direct material and direct labor is the 5 per unit. Monthly rent, we know this is the fixed one. And absorption cost. What is absorption cost? Absorb, right? Absorption cost is variable cost per unit plus the fixed cost per unit. So both. It means normally we don't calculate the fixed cost per unit. But if we want to know about the absorption cost, we need to calculate the fixed cost per unit. So how we can calculate? It's very easy. Variable cost, this is the variable cost per unit is available, right? But if we don't have the fixed cost per unit available, we can calculate what is the fixed cost is a 20,000. So 20,000 is the fixed cost. How many units that we have produced in this month? 10,000. So 2 per unit of that will be the fixed cost per unit. We know the variable cost per unit is 5 already given, right? And 2 is the fixed cost. So 5 plus 2 is equal to 7 per unit. That will be the absorption cost. Now, if we want to know what is the cost of goods sold, so let's say the $8,000 units, 8,000 units have been sold here in this month. So $8,000 and multiply by 7, that will be 57,000. That will be the cost of goods sold. Inventory, we have 2,000 at the rate 7. So that will be 14,000 inventory that we have. So two figures we can calculate with the help of cost and a fixed cost per unit and variable cost per unit in this way. Now, for example, this is the one example that we have completed. Now, second example that we have, if, for example, the production cost is 60,000 units, right, in a month, and we have sold 50,000 units and 10,000 remaining. Selling price is 100, right, 100 per unit. If we say that direct material 25 per unit, direct labor 20, and manufacturing overhead 10. Variable administration cost we are not going to consider. Fixed expenses of manufacturing overhead that we will consider, but fixed expenses for administration cost we are not going to consider here. So for absorption costing, now look at this. Variable cost, we know that 25 plus 20 plus 10 is equal to 55. Right, so this is the variable cost per unit is 55 units per 55 per unit, $55 per unit. Now fixed cost is a $300,000 here. The fixed cost divided by how many units produced? 60,000 is equal to 5. So 5 is the fixed cost per unit. So variable cost plus fixed cost is equal to 60 per unit. That will be the absorption cost. So inventory is $10,000, means closing stock that will be the 60. Closing inventory will be the 600,000, right? Because that we know this is the cost, absorption cost. The formula here is direct material plus direct labor plus variable production overhead plus fixed production overhead, right? So that we will be able to calculate. And divide by number of completed units. So that will be the formula for calculating absorption cost. So the disadvantage of the absorption cost here is that this is because of the fixed overhead is assigned in the total number of units produced, right? and this is definitely will be lowering the cost of each additional unit produced. So when you are going to produce more and more units, right, so definitely there will be totally effect on the fixed cost per unit. Okay, so this was just about cost volume profit analysis and absorption cost.